Hi everybody, and thank you very much for joining this webinar on knowledge graphs for concept-based investing. In terms of the format today, first of all, I'll cover a couple of housekeeping points. So we are going to be recorded, so I wanted to make everybody aware of that. And in terms of the format, please feel free to send questions at any time over the chat, and we will be using the Q&A at the end to answer further questions. If we can pick up the questions as we go along, we will, and if not, we will cover them at the end. So in terms of introductions, for those of you who missed part one, I'm delighted to be here today with Tony, who is a portfolio manager and executive director at RAM Active Investments in Geneva, Switzerland. So welcome, Tony. Great to have you with us here today.
Hi, Ruth. Thanks again for having me a second time.
It's great. So before we start off with today's call, I wanted to check in with a brief summary on the webinar on the 1st of December. And I was wondering, Tony, if you could briefly summarize what we covered as a little recap for those who missed that call.
Sure. I will seize the opportunity to show some slides in order to do the recap that starts at slide 3. Well, first, before recapping and doing a sum up of the results, I wanted to summarize the parameters of this research exercise. What I imply behind that is we had the why, we had the rationale and idea that we wanted tested. And those are the parameters of this idea, this research exercise that we carried on together. Among some of the questions that we received also, the first one was how to select concepts. It's true that the Yewno database has an extensive and very long list of concepts, which is in the multi-millions. And people have been asking me how I come up with the 30 that I've selected. And this is a very interesting question that I want to address now, which is one of the findings that is going to be illustrated in the following slides, which is when you face this almost infinite number of concepts to test. The first reflex should be to focus on the smaller parameters in order to access to your own domain knowledge. In my case, I've been trading stocks systematically for the last 15 years. So I knew that some of the factors, some of the signals that could be related to concepts or topics could have been found in the Yewno database. And that was my first starting point. After that, as you can see in slide 3, the database provides several different scores and metrics. I focused in my study on only 3 of those in order, again, to have a very pragmatic point of view in my modeling phase, which was to focus on the most covered scores in order to have a better cross-section. On top of that, the type of the data on which the graph and the exposure to the concept scores are produced, the type of data is also important. In this case, I already only tested the news feed with a 2-day lag. And those are the main parameters in our research. Our research was also having couple of, let's say, layer. The first one was to assess if a standalone concept could be interesting. And maybe we could switch now to slide 4 in order to dig into more of those insights from part 1. As I was saying, the first one that was the most important for me is to use domain knowledge as the first step and to have confirmation that you can apply and you can search for all the criteria, the signals that you have a good experience with that proved to be successful in the past, and find concept related within the database. This has been a real findings. The second one has been, which is one of the first part of this whole exercise, is to assess the added value, what somebody can access by a standalone concept exposure. Is a concept, could be a signal that you can trade? And I provided some example of that, and was also the second biggest findings for me. And finally, the third one is even if we tested and we carried on this research on a very highly liquid, so basically the top 300 of the S&P 500, those stocks are large caps by essence on US markets, and the fees associated with trading them even on a, let's say, a pronounced basis that could be 25% per week is still manageable in terms of the fees. And even in this very challenging universe, we found interesting first base machine learning alpha signals based on data sets composed by only concept exposure. So using a concept exposure database as a data set creator proved to be also very insightful and positive. In slide 5, shows some of the findings that you can, if you want to dig into that, you can find in the webinar part 1.
How were you able to find the concepts that provided the strongest signal? And what methodologies can Yewno implement to identify the concepts that carry this signal?
Okay, so on the first part, how I did it is to use domain knowledge. And the closest exercise that I already been familiar with was to find topics on using NLP sentiment based. And some of the topics that you can find in very interesting NLP based model are very close to the concept that I've selected. So this is a blend of what is in the NLP/sentiment literature as a good topic for related to fundamentals on equities, plus some of the extra concepts that I wanted to test, such as securities fraud, CFTC, which are sensitivity to event that I think that could only be found at this level of granularity using graph knowledge signal. Second part of your question, how Yewno could help? But I'm guessing that since you can access, and you're already doing this thing when you're searching through your API in this concept search, you always access to the sub-concept, such as at the lower level, lower layer, if we might say, of some of the graph. So I'm guessing that if there is an axiom that somebody wants to follow, for instance, I don't know, energy, it will be easier for you to derive a concept related to energy in the first parameters. That would be my guess. The third potential avenue would be to test to some extent on a very specific case, for instance, predicting a stock's return, all of the potential concepts, but that will require a lot of time.
Great. And in terms of the research that you did you incorporate transaction costs and liquidity constraints in your exercises? And is the signal from the data still strong after considering liquidity costs?
So in the first set of presentation, I kept the transaction off, but I applied some liquidity filters at first. So if we selected the top 300 stocks from the S&P 500, which are by essence large to mega caps. And the estimated cost on the Sharpe ratio on the best iteration of the machine learning model that I'm provided at the end of the slides in part 1 is going from 7.77 to 0.69. So this is a small cost in Sharpe ratio. Why? Because even if this is a very challenging universe, and that was my point in the first place, I wanted to test it first in a very challenging, highly competitive equity universe, or very small spreads, because obviously everybody which is running signals on quant equity knows that those signals tend to amplify when you're going through the mid cap and the small cap part of the market.
Great. Can you explain what the benefits of training your models using the tails of the data is?
Yeah, sure. That's a very good question. So potentially, if you go to page 9, I prepared a small section in the second slide deck. Since training on a tail is a machine learning concept, I wanted to seize the opportunity to include machine learning with graph knowledge data. in order to explain to people how it's important. And it has been very convenient for me to test some of those concepts in a machine learning way. So in slide 9, you're seeing 4 points that are points that are usually talked about on the machine learning context. And on green, below each of the points, you're seeing the link that explains for me how machine learning and graph knowledge, it's one of the best, let's say, or perfect matrimony that you can find in applying modern approaches. The first one, obviously, is with machine learning, you can test a lot of signals, a lot of characteristics, which is a good thing because you have a million of them, million of concepts to test in this database. The second one, which is obvious also, it's applying machine learning is try to extract this nonlinear complex pattern that our beautiful human mind cannot understand, because you cannot reflect more than and project more than 4 dimensions, and 4 it's already tough for us. The third one is, as long as you follow a decent protocol that recreate and retrain from scratch your model, as long as you're progressing into your data samples, well, you can throw and adapt and identify using these machine learning warning models. And the good thing is that since there is so many potential emerging concepts, gradually you're going to include new things, new exposure on a systematic automated basis. And this is extremely important for me in order to adapt to recent events or to factor in a certain window of time in the model. And finally, this is a great way for me to be less dogmatic, to have a much more objective point of view in my modeling efforts. So the two together makes a good match. So getting back to potentially the following slides and trail training, the idea of tails training is, we published a paper. It has been an effort co-author with my friend and research pal, Guillaume Coqueret, who wrote a book and papers together about machine learning and finance. The idea is very simple. What we had in mind is, when you think about stocks in a universe on a cross section, right? In a machine learning model, you've got a lot of characteristics of features. And what you try to understand is there a link? Can I find a model that's going to predict this out of performance, this cross-sectionality of feature performance using those signals, those features in my data set? But if you think about that, a stocks that is just barely outperforming or underperforming the market should have some reason behind it to be a boring stocks, let's say. Let's call it boring. Nothing happens. It's barely outperforming, barely underperforming. So why, taking into account the noise that those fundamentals metrics related to those companies or price momentums or any signals, why do we include them in the modeling phase? We don't need them because they are very few information. There's a small moment of energy that you can leverage on in order to find model and to understand the best nonlinear approximation for future prediction. So potentially, if you go to page 11, I try to extract one of the easiest graph and potentially easier to understand to illustrate this tail event. So if you focus on the right-hand side of slide 11, you'll see a very funny graph where you have three curves, which are the market cap, the momentum, and the price to book. Think of those as scatter plots, right? This is one variable according to the y-axis, which is, as denoted by the black label, the forward return 12 months, which is 1 year. What we are seeing here on the far left side is stocks which are having the lowest level of return for 12 months forward. So this is potential short candidate. On the right-hand side, which is depicted by the green square, you've got the high performing stocks. And if you focus now on the curve, you'll see that the movements related. So in order to understand if a generator or a signal, a feature is a good predictive of the label, the y at that we have here, you see visually that the movement is much more pronounced in the tail parts. And this is exactly what we want to capture. We want to capture a lot of movements on those stocks that prove to be in the past outperforming or underperforming, in order for them to reveal a generalized model that will you use on a full cross-section. And this is the idea behind training on a tail. On top of that, it has a very nice, important feature in machine learning, which is it cuts the running time of your model, the training time, by the number of quantiles that you get rid of. So it's faster, it's more accurate, and it's giving better out of sample results. So it looks like a no-brainer when I said it, right?
Fantastic. Could you take us through in a little detail about why it's really important to include concept-based approaches for quants going forward, and why those not adopting this kind of approach are going to be left behind?
That's exactly what I wanted to mention in the last point, with to be less dogmatic, without entering into the bashing phase, because you can always find yourself underperforming in the market. Over the last 5 years, people should have seen that the movement of short-term, the importance in short-terms in the quantitative space is increasingly higher, even on the good results of multi-strategy. And those short-term movements, most of the time they are abrupt, they're highly volatile, and they are bearing an idea, an event, something's behind it that triggers those moves. Most of the time, this is emerging concept, this is emerging ideas, things that were there, that a news is triggering it. So this need first to cope with a very highly dynamic, highly volatile, and much more faster investment universe is the first reason to include concept-based, because you're gonna end up having a way of automatically, in a fully automated manner, including new exposure progressively. I'm not gonna say that nobody is capable of predicting the future, but it sounds like a very exhaustive way to cope with dynamic new events in financial markets those days.
Great. So as we round out 2020 and we look forward to the new year, what trends are you going to be watching for in 2021? And beyond that, how do you plan to leverage the power of artificial intelligence?
That's very good. That's a very good question. Some of that could be sum up as what are my latest obsession lately. Well, knowledge graph as a whole is extremely important for me, because it seems that could be blended beautifully with the firepower of different machine learning algorithm, which I do like to use, deep learning for sure, genetic algo, which is a different branch. So how to make everything works together on a high scale is something that will require a lot of work, a lot of testing, and a lot of framework. So that will be my path in research, and also professionally speaking, for the next foreseen 12 months. On top of that, regarding this database in particular, I did only scratch the surface in terms of concept, but I also scratched the surface in terms of types of data. So, and some techniques in machine learning could be extremely interesting to use in order to show if on the same types of data, for instance, patent, NLP models, what are the output of NLP models versus graph knowledge? That will be also in a link of machine learning / AI type of research that I plan to do a little bit this year, for this next year.
That sounds great. I was actually going to ask you, because I know that this research was based on news with a 5-year history and a 2-day window, and I was going to ask you if there were any other data sets you're curious to test next. But if you're interested in testing patents, Tony, maybe we can invite you back next year at the end of one at some point to talk to us about patents, because I agree with you, super interesting data set, and you're going to find some very different things. But let's hold that one then until the new year. And let's move on to another question, really for the finance industry as a whole. So what limitations do you see in the finance industry? What do you think the kind of limitations people are still facing in terms of actually being able to harness data for actionable use?
Okay, I will have one very professional answer and the second one, which will be slightly more philosophical, but for me, they're as both important. And the first one is, it seems that whether you like quant strategies or quant modeling or quant signals or not, it seems that now everybody is blurring a little bit into something called from time to time quantamental or discretionary with quant tools. Anyway, what is obvious, and especially here today, since I'm literally talking to my screen, is that technology is taking biggest share of our life everywhere. So it should be translated at some point in data points that could be used. And in order to access, use, and harvest those billions of new data points that's going to be created by everyday's life, like consumer received, anything, you'll have to embrace new technology. But in order to embrace technology, you have to be extremely open-minded. And that's the problem, I think, one of the biggest problems in finance. I think that there's still room in finance to find a sweet spot between what could be an optimal financial community, which is already existing because I'm working with a lot of people in a finance community, and those people could have daily job that might look like a competition with me, but that's not. Ultimately, this community aspect, this sharing knowledge aspect is, I think it's missing somewhere. We should work on that and find a way, a shape in order to make it, to make this community grow. And that's a big push on a break in terms of innovation. So the biggest problem I will say in finance is how can finance can foster innovation without tripping into the old enemies, which are legacy of system, legacy of politics, and obviously my final philosophical point, full range of egos. When you see that it's very difficult to have effective teams working together, and the process of innovation and ID creation, when it's not fully automated with protocols, KPIs, and clear-cut expectation, it's starting to become something which is less rigorous, less scientific. And I'm guessing that on those two aspects, I'm hoping and I'm trying also to help finance find the cure to some of those poisons.
Thank you very much, Tony. And I think, you know, I don't want to put you too much on the spot. You've given us some ideas of, you know, how you kind of see these issues and some ideas how you might consider they could be addressed. Did you want to expand on any other points? And if not, I'm going to open up to questions from the audience.
Well, generally speaking, and again, in order to be clear, I think that graph knowledge database is extremely important. Why? Because I'm still very surprised positively by the amazing coverage of concepts, and having spent some times, but not a lot of times, digging into that, I'm guessing that you can find a lot of emerging combination of concepts that could be very helpful. Also on the risk aspects, not only on the investment side. And that's something that I wanted to stress that out because I used to work a lot on performance attribution and risk attribution. So I'm always cautious about those themes. And risk optimization is also a big part in a branch of financial market investing in quantitative modeling. So I think it was important to mention it.
Fantastic. So we have got a couple of questions that have been sent in, and please, anyone in the audience, do feel free to send in any further questions. But I'll start off with the first one, and I'll read it out so that everybody can see. So the first one is, where do you see the biggest application of this data within the quant industry?
Signal creation. That's linear and nonlinear. That's a no-brainer.
Great. And the second question we have is, could you see this data being applied for macro research as well?
I think so. I have to be extremely honest. I didn't dig into that, but I've checked some of concepts related to energy, because in my day job, I'm also co-managing a systematic macro fund. So obviously, I had the curiosity motivated by my daily job. And I'm guessing that out of 1 million concepts, I would be very surprised to see key macroeconomic concepts such as CPI, balance, trades, SEC. You already have a lot of those legal, regulatory topics, events topic, catastrophic topics, in order to model commodities. And yes, I'm pretty sure, but that would be a very good exercise for additional research, by the way. But again, out of 1 million concepts, and since I've checked for energy, macro-related concepts, I was satisfied again and thrilled to see how many sub-concepts and potentiality there was.
Fantastic. So we are running out of time, but don't worry, if you've asked a question in the Q&A, we will be taking those out of the Q&A and we will be emailing back the response. So just in terms of wrapping up and next steps, I just wanted to say, first of all, thank you very much to everybody who's joined us this morning. And thank you very much again to Tony for all the effort he's put in. Very, very much appreciated. So we will be sending out the recording. If you'd also like the slides, or if you'd like a fact sheet, please do email either Fabio or Alex. And we are hoping to do a further webinar in about March, looking at the different patent data that we discussed. So again, thank you very much to everybody for attending, and a huge thank you, Tony, to you at the end of a very long day in Switzerland, I'm sure.
Thanks a lot. Be safe, everybody. Be well, everybody. Bye-bye.
Bye-bye.